Welcome to the daily update, where I'll go over the action in the market for Thursday, April 10th, and we'll see how things look for Friday, April 11th. You've got a market that really doesn't have a lot of structure right now. And we have a big up day like we saw on Wednesday, then we have a down day on Thursday. You've got a lot of folks running scared right now. They're not quite sure what to make of this trade war between the U.S. and China. That's really what it seems to be boiling down to. And we had that big update, but there wasn't an awful lot of buying. I mean, there was buying in the sense of the short covering. They have to buy to close, and that's what really pushed prices up. But if you're trying to find the bottom in this market and buy low and sell high, you're now likely underwater at this point. And so there's just it's really crazy at this time. We've got things that are really happening in the stock market, but we want to keep an eye on the bond market. Now, I am not involved in the bond market, but there's a real relationship between the stock and bond market. It seemed to settle down a little bit on Thursday. We'll see if going into Friday, things can stay under control. All of this has to do with all the shifting going on with the tariffs and the trade wars and things like that. And it's really keeping people confused. It seems like we have one good day and some of our indicators start to show some improvement. Then we have a bad day and then we get a mixed picture. Some things are still looking positive, some are still looking negative, and we're kind of blowing through support and resistance levels. And it's not really structured right now. Okay, so let's go back and right at the open we had a gap lower open. The futures were negative. That sent us lower right out of the gate. And we dropped down below the daily pivot at 52.96. So now we're under that 5,300 level. But we were able to find support slightly above S1 at 51.10. The market was just headed down. It's like, okay, here we go again. But we did find some support and we were able to bounce back up to the daily pivot again. So we kind of did a round trip there. But then we declined. We found support at around the 5,200 level now. And then we closed a little bit up off of that, but below the daily pivot. So we ended up being down 3.46%. We're seeing massive percentage moves. We had that big move up on Wednesday, and we're down on Thursday, and we're still positive on the week, believe it or not. It's probably going to come into Friday's session to see are we going to be able to go up from here or down. And we're well above average with volume. So there's a lot of volume going on, but it's like scared volume. So, okay, but we are still negative in the short and intermediate term. We're mixed in the long term, and we're getting concerned because every day that we're below the 200-day moving average, that 50-period moving average is inching its way closer to the 200-day moving average. And if we drop below that, that's going to shift the long-term trend to negative. And there'll be probably a lot of gyration if that happens. We can go above and below because a lot of people, this is what they use as their main get in, get out point for very long-term investments. And there's other folks that are going to try to think that maybe we'll get some support here and we can jockey around these levels. And so it can take some time for that to play out if we are, in fact, shifting over to negative. Now, we've already gone negative with the small caps, the mid caps, the NASDAQ. The NASDAQ 100 is close, but not there. The Dow is close, but not there. But the S&P, excuse me, one more time there. Gotta love these take one videos. The S&P, as I've been saying, that's the real foundation of the U.S. stock market. You can have all these other indexes, but the broadest, best benchmark for the US stock market is the S&P 500. That's why it sees the most volume. That's why the whole program that I focus on is on the S&P 500. We can be dealing with the entire US stock market and they're at one time when you're dealing with the SPY ETFs and different option strategies and things like that. Anyway, so we're just keeping an eye on this. And if this really starts to shift more negative, that's going to have some pretty significant ramifications. And it's all about the tariffs and trade war and things going on back and forth there. Okay, so there was really, in fact, there was no follow through to Wednesday's advance. And this, you kind of have to look at the data to try to really see what's going on here. But just by looking at the chart pattern, it looked like it was mostly short covering at that point. There was probably some people, you've got these folks that really have this buy the dip mentality. Do you think this is a good buying opportunity? We've dropped in price. Yeah, we're going to go back up. I just don't buy into that. We have to wait for confirmation from the charts, not some intuition, not some feeling. You see things starting to go up and you immediately want to jump in when really the overall climate hasn't changed. It's it's looking like, okay, the train's coming at you and it might be slowing down, but it's still coming at you type of a thing. And that's why I like to look at the charts, look at the evidence, not based on what some kind of emotional thing that we're going off of here. And that's why it can be very difficult during times like this. Okay, so the S&P was down 6.3% when it hit that low in Thursday's session. That's a big move, and that's giving back a huge chunk of what we saw on Wednesday. And then we're back above 40 now with the VIX. We're at 40.72. That's elevated fear still. And then we're in the process, and I'll show you the chart later on. The Nasdaq is now generating a death cross. We're already there with the small caps and mid caps. But now we have the big NASDAQ composite, which is mainly tech and a lot of cutting edge technology there. That's now switching over negative, where it was actually outperforming the NASDAQ 100 for a lot of 2024. Now it's seeing more weakness. Okay, in the short term, not a very long list, and we don't have our usual charts on this list that show us that we're trending one way or the other. The Stochk RSI, the Williams percent are the CCI 14 and 20. Even the stochastics are not on this list right now. You've just got a market that's just bouncing around at this point. But currently, we are seeing an extreme negative reading with the 20 period exponential moving average on the S&P. The rate of change, and I noticed that the 5 period and the 20 period, those have fallen off. Well, we're still looking extreme negative with the 10 period. And then the momentum oscillators are still really confused right now. The short-term slope oscillator, the MACD, which is more short to somewhat intermediate term. And now we're back to being far away from the 20 period moving average again. That's what the boom indicator measures. Intermediate term, still a pretty long list here. The TTM squeeze, it was showing some improvement after Wednesday. Now it's going back down after Thursday. And then the 50 period moving average on the S&P itself, the rate of change going back 50 periods, the Arun indicator, which measures the difference between buyers and sellers, the PMO, that's a momentum oscillator there. And then the studies that go along with that, the Sean trend meter, and the bullish percent indexes for the S&P, the NYSE, and the NASDAQ 100. And we're also back to being far away from the 50 period moving average. We're well below that. And the idea is that when we get far above, below or above, that we snap back to the moving average. It just hasn't been happening really, at least yet. In the long term, we're still looking extreme with the 150 moving average study there. The Fed really is not participating in what we're seeing right now. So we got the meeting minutes. Wasn't really anything the market chose to react to. It's mainly focusing on these geopolitical things that are happening right now. But they just pretty much came out and said in different speeches and things like that, we're worried about inflation going up and growth going down. That's kind of where they're at right now. The dollar was down and it's been getting hit hard. And there's some things that I'm going to talk about here in just a minute. It, at least on Thursday's session, it looks like interest rates settled down a little bit. We actually declined from 4.4% to 4.39%. I'm going to talk a little bit more about that here in just a moment. Sentiment, we're still well below that 25 level. Even after the big up day on Wednesday, we only got up to 17. Well, with the decline, now we're back down to 8. as far as sentiment. We're still not inverted with the 10 to the 3 month yield curve. That's gone back to being regular now. So if it stays that way, that's when we start to say, okay, from here forward, now we start to see, we start looking more at the employment charts. We start looking more at all the economic reports that come out. Are we seeing a real slowdown in growth? We look at some of the GDP forecasts because now we start to go, okay, are we going to in fact go into a recession? But we could slip back down and go inverted again with the 10 to the 2 year, that's doing fine too. And now we're not inverted with the 10 to the 3 months. So now we start that clock. And there's no really set time for that. We just are on kind of heightened alert right now. And we start looking at the economic reports and saying, okay, what is it suggesting to us? Or are we going to, in fact, go into a recession? All right, we're negative with the trend. The ADX is still above its moving average. The red line's really been coming down. It's no longer extreme there in the short and intermediate term, but we're negative across the board. And because we had the down day, the bias is negative, and I'm still keeping our momentum at negative. You've got a really confused market that's continuing to go on here. All right, so CPI, the second most important report of the month after the employment report. Market really didn't react to it. It could have gone to the races on this because it shows inflation actually coming down. It was down 0.1% on a month over month basis. They expected it to be up 0.1%. And on a year over year basis, we're getting closer to that 2% level that the Fed is trying to reach. But they focus more on the core PCE report that'll come out later. But we're down to 2.4% last month when we did the annualized um, inflation rate, it was 2.8%. The market could have just went to the moon on this news, but there's all these other things going on right now. And then core CPI, this is the inflation component, also came in weaker than expected, up 0.1% month over month. They expected it to be up 0.3%, and we're still a little higher here with the inflation component. The Fed's target has been to get it down to 2%, and we're still at 2.8% on a year over year basis. Then we had jobless claims. This is still holding up for right now. They actually decreased a little bit here. And so that's something that we keep an eye on, but not anything that's really causing any alarm right now. The continuing claims did go up, and I'll have a chart to show you there. So people are staying unemployed a little bit longer. And then this is mainly more for informational purposes. The Treasury budget, there was a minus 160 billion down from the minus 236 billion. It was less negative when we go back and look at this from a year ago. And so the deficit so far in 2025, it's 23% greater than the deficit that we saw the same time in 2024. And that's kind of like, with this budget that's being passed and a lot of this stuff that's going on in Congress and this continuation bills and things like that, it's like, okay, we need to raise a lot of money right now in order to bring the money back down later. And some people think, okay, well, that's just, you got to spend money to make money kind of a thing. But at the same time, it's like we've heard this story before, and then things change, and we never get to fix the problem that this is trying to solve. So, um, yeah, there's what, $37 trillion dollars in debt with the US, and that's got to be dealt with in some way, and it's going to have to start with the budget that the government operates on a year over year basis. Okay, so now this is the extra part. Now, what I did, I knew the answer to this, but I figured this would be an easier way to sum this up, and I'm having a real problem with my voice here. I went to Grok. That's kind of the AI platform that I've been using lately. I know there's Claude, there's ChatGPT, and it's like every other week, it's one of these platforms actually, they say this one's the best. I've been using Grok for the last couple of months. For what I need it for, it does a really good job, and we're just growing from there. And that we actually like that because all this AI stuff, they're competing with each other to be the best, and that's where we benefit from it. But I just said, I typed in a question. Who owns the most U.S. government bonds? What other countries own them? And it's the same as what it has been for a while. But this could be part of what's going on here with the trade war between China and the U.S. Now Japan owns over 1 trillion. Now they're more friendly with the U.S. and ever since World War II, we've been allies. And through rebuilding things after the war, we basically set up a Western style of government within their Asian, more ancient style of customs that they have, the samurai and all that. But they own a lot of U.S. debt. That's not necessarily the problem. The problem is China comes in second, and they own 760 billion of U.S. treasuries. What happens between this war, between this trade war between the U.S. and China? Because Trump seems determined. You know, if China comes in with saying we're going to raise these tariffs, Trump comes in, we're going to raise them even more. And you've got two countries that are playing hardball here. And what this is one thing that China could do to hurt the U.S. is they own 760 billion of U.S. treasuries. Are they coming in and actually selling these? Because if they sell them, that pushes the prices down and interest rates up, and that's freaking out the bond market, which could freak out the stock market. And that's why I've been saying we need to watch bonds right now. It may not be necessarily I mentioned in yesterday's video, some hedge funds or they use bonds to kind of do some maneuvering and some different strategies. And that could very likely be going on too. But another possibility is that China could be coming in and then selling these bonds to as retaliation, basically. And we've known about this for a long time, decades, 20 years. China's always owned a lot of bonds, and is it because they're good investments or that this is a potential weapon that can be used at some point in the future against the US? And that might be what's happening. Now, we can just kind of guess, we just kind of keep our eyes open to see if this is actually happening. But unless you're really on the inside of information, it's really hard to actually see this happening. We'll probably find this out more in retrospect, you know, by looking back and saying, oh, that's what was going on. So in the meantime, I'm just watching the bond market. And what I do is I have a real-time chart of the 10-year yield. That's what I watch, not the price of bonds. I'm watching the interest rate for bonds. And it's calming down a little bit, at least in Thursday's session. Now it could go crazy in Friday's session. So that's why we need to keep an eye on this. And just to continue out here, the UK, they have 723 billion. It's not like, you know, we had this little thing called the American Revolution where we broke away from them, but we've been pretty good friends. No, then we fought the War of 1812 against them. And but we kind of mended our different ways there, but they still own a lot, but they don't seem to be as much of a threat, even though relations are kind of not as good as they've been. Luxembourg has a lot. Canada, okay, had a little bit of Canada problem there. They have 424 billion and 329 billion respectively. I mean, still, they could come in and start selling those. And these figures shift monthly. Actually, they shift daily, but because they do change so much, they come out with monthly needs, and it's based on economic policies, currency needs, global market conditions, and then just the Cayman Islands, Belgium, sometimes they come up, they'll own a lot of bonds, and then they won't there for a while. So this is just using Grok. I just typed in which countries own the most bonds, and then this changes periodically. Okay, so I hope that because I've been saying watch the bond market. Well, why? Okay, because China is number two, and if they start selling it, which they might already be doing, and that's going to push interest rates really up, which could really have an effect. We could see a loss of confidence in the bond market. Now, there's the stock market that goes up and down, but it still goes up 70% of the time and down 30% of the time. But the bond market is real where the real confidence in the US comes in. And the folks that are in that market tend to be very knowledgeable. And they tend to really pay attention to what's going on economically, where in the stock market, it's like, just buy low, sell high. Give me a good stock. Is the SPY going up? I'll get into an ETF. Where it does take more effort to really study the bond market and see how things interact with each other. Okay, we did have some economic reports. Weekly jobless claims. The moving average is starting to flatten out after it had been declining, but this is not falling apart. This is one of the areas that we want to keep an eye on to see, okay, are we going to in fact go into a recession? We will tend to see employment really show some weakness. Continuing claims did decline here. I think I said they went up. I meant to say that they declined, and we're pretty much flatlining right now with the continuing claims. So that's not falling apart right now. And so we have the red line, which is the initial claims, the blue line, which are continuing claims. And you can see we've been pretty solid. There's really no trend per se going on right now with either initial claims. If anything, it's a little bit to the downside. And then also plotted on here is the unemployment rate, which we had a week ago when the employment situation report came out. Then we had CPI, and the market could have really liked this and saw follow through buying, but that didn't happen because of all these other things that are going on right now. Then on a year-over-year basis, the blue line shows CPI going down, and then the core, the inflation component, that's also declining, and that's a good sign. And then looking at the services and you take out energy, that's the blue line, which is declining. And then the core commodities, they had been coming up. And we were seeing kind of a relation with this with the CRB index, which had been strong there for a while. And then it just started to not be strong. And so it's showing up as flattening out right now. And then the federal receipts and outlays on a month over month basis. This is how much they're bringing in as the blue line, and you can see how much is going out as the yellow line. Now, if you run a business or if you run your family and you see a chart like this, yeah, you're a little concerned. You're spending more than you're bringing in. And that's another concern about the interest rates and the kind of the dynamics that are happening right now is that okay, if interest rates go up and the Fed's going to have to refinance their own debt and pay out more in interest, is that going to affect the inflows into the government? So, there's all these different things kind of going on at the same time as things are trying to be worked out. Then here's the chart that I showed, the CPI. This is just looking at the headline number. It's actually declining a little bit here on a 12-month rate of change and also actually starting to go negative on a month-over-month rate of change. This is the core CPI, the inflation part. It's also declining both on a year-over-year basis and on a month-over-month basis. And then this is the Treasury budget, which is negative. It's always negative, but it's a little bit less negative than it was before. All right, then looking at this, this is a variation of the chart that we've been following. This is the spread between risky and not as risky bonds. I don't have that chart today because it's actually improving a little bit, but and also because I had access to this chart. This puts some standard deviation lines on here just to give us an idea of where we're at with all of this. And we can see the blue line, these are the junk bonds. They're risky bonds, but they pay a higher yield because people are willing to take on more risk to get a higher return on that. And these bonds may be for a takeover of another company, um, or some kind of a research or project or some goal or vision that a company has that could be really risky that may not end up working. But if it does, you're going to get, a good return on that, or a company that maybe they've had some difficult times and they're coming out and trying to straighten up those difficult times and get better. Well, they're going to have to pay out a higher rate of interest to entice people to come and invest in their bonds. And that's the blue line here. And then the investment grade bonds. These are like government bonds, the really high quality companies that put out bonds, maybe like General Electric or Microsoft, even though I don't know if they have any debt. Um, and the companies that have really stood the test of time and they're considered safer and they give you a lower return. And then the chart that we follow looks at the spread between the two. And when this starts to really get wide, we get a little bit concerned about that. Well, this breaks them down into the different categories and then puts these standard deviation lines on here. So, yeah, we are watching this, and it can be a concern if it continues to go up, but it's not really freaking us out at this point. We're still below this higher line here, which is an average, which is kind of like a standard deviation way of measuring this. And so even though this is going up, we're still below the average overall. Just another thing that we want to keep an eye on. If the economy really starts to run into problems, we're going to see both of these really spike up. Okay, at least that's in theory what should happen. Who knows what will actually happen there? So spikes over 50 are rare with the VIX, but potentially bullish. Okay. I don't know if you can really apply a lot of statistics to what's going on right now, because when the idea they made up this clever cliche about the VIX, when the VIX is low, it's time to go. That means sell. And when the VIX is high, it's time to buy. Well, yeah, but how high is high? I mean, we've been up into the 40, 50 range now, and we could still go higher than where we're at right now. This just says, okay, when we get above 50, all right, okay. And the returns, at least the further out you go, the better the returns look. Um, I don't know if I'd use this as a hard and fast decision-making tool right now. And then non-US markets, while cheap and relative to the US, are not particularly inexpensive to when they compare them to their own history. We're actually dropping below 20 with the PE ratio right now, and that's because we've been coming down. And I'll go over this again more in detail in the intermarket analysis video over the weekend. And then you just have the different world markets here and what their current PE ratios are. And then it compares them what their PE ratio is compared to what it has been on an average basis. Okay, risk appetite. People aren't willing to take a lot of risk right now. They think that they're trying to avert risk over the next 30 days or so. And then they think that even though it bounced back up with that huge update that we saw on Wednesday, people are still expecting the market to go down, which could actually, when it gets to a low reading like this, could be a contrarian indicator. But we've been following contrarian indicators for weeks now, pretty much for all of April, and they're not really giving us anything to be contrarian about. These readings are coming in very low and they're just staying there. That's why we watch sentiment. All right, and then central forecasts around valuation. This is also something that I'll probably go over in the intermarket analysis. This is looking at the forward PE ratio, and based on what analysts project as far as the earnings per share, this is if they actually go lower, that would produce an 11% negative year over year growth. So it'd be going down, and of course that would push the S&P down. The baseline is kind of right around where we're at now. That puts us at 55.50. And if earnings continue to climb here and actually start to kick back into gear, that would justify prices going back up and then coming up with the various different PE ratios as well. Then here's the forward PE. We're coming down into the 18 range now, where we've spent the last probably year or so. I'd have to check it to be sure, but quite a bit of recent history has been spent well above 20, which means even looking forward, the market is considered expensive. All right, JP Morgan key scenarios. Okay. All right, they can come up with their little types of forecasts looking forward and even use different colors, but yeah, okay. Some are saying if we're bullish, we're going to go back up to 5,800. If we stay about where we're at, it'll be 5,200. If things really get ugly, 4,000. Okay. I don't see much use or value in these, but some people do. People like forecasts, even if they're wrong. They still want to hear, what do you think's going to happen next? And that's why I take a whole different approach. We just evaluate, okay, where are things at right now? Not necessarily what we think they're going to be a day, a week, or a month from now. And then US bear markets and recoveries going back to the 1800s. Okay, this is just more for historical, um, where the average decline is well over between minus 30 and 40%. And okay, then the average length is usually a couple of years here, 25 months or so, with the average being between 10 and 15 months. And then the average time to recover, that can go out for a number of years. And this kind of just shows that, okay, yeah, we seem to be in that 30% of the time when the perma bears think that they're geniuses because we're actually going down. But over the long term, they're wrong 70% of the time because we end up going up 70% of the time. All right, then here's just some interesting charts. Carson put this out. Big gains tend to lead to much higher prices. Well, not in Thursday's session. But a lot of times, what'll happen is we'll be going down, we'll hit a bottom, and then we'll V bounce up out of that, and then we usually keep going. Well, the situation is not the same this time. There's actually quite a bit of a variance going on there, but these are the statistics looking at 1 month, 3 months, 6 months, and a year into the future. And then spreads at a risk from shaking in confidence. This is also looking at the high yield spreads. This is more like the chart that I've been showing, but I have this chart too, so I'm not showing the charts that I usually show here, where we have the gray line here where this going up, even though it's inverted, this just shows that fear is increasing. Actually, I'm sorry, it's the black line that shows the spread, and then this is CEO confidence. And that plays into it a lot. These are leaders of companies, and they're saying, how confident are you in the economy going forward? We're actually reversed here. Their confidence is actually going down as these spreads have been going up. So they're less likely to hire new people. They're less likely to expand. They're less likely to keep people on the payroll because they see things getting a little bit worse down the road. And so that's why they measure CEO confidence about things going forward. And then here, this is what we've been following here. This is what has been happening since Liberation Day, which was April 2nd. Okay, and then what's the 10-year yield, or sorry, the 30-year bond done since then? Just really gone up. And then what's the dollar done? It's really gone down. You would think it would be the opposite because the U.S. taking a stance and saying, okay, we're going to put these tariffs on, we're going to, make things more fair. The dollar should be going up and it's actually going down. And that's another play that some of these other countries can do is not only with the bonds in the U.S., they could start really selling the dollar and seeing some weakness there. So that this indirectly can have a real impact on the stock market. And sometimes that indirectly can be more direct, and other times it kind of backs off and doesn't have as direct of a relationship. Okay, here is the chart. Here was the big update here, and kind of how you can tell that this was short covering, especially near the end of the day, is we just kept going up and up and up and there was really no retreat from that. And then, of course, we gapped down here in Thursday's session, broke below the daily pivot, almost made it down to S1. We're dealing with the 5100 level down here. And we found some support, bounced back up, but now the daily pivot is becoming overhead resistance. We fell back down to 5200 and then closed up off of 5200, but still below the daily pivot. All right, and then when I first started preparing things for the video, we were down about 1%, and then when I started recording, we were back to unchanged. So things are just remaining crazy for the time being. But here, right after we closed, this was the really solid update. But then once we got into the overnight session, boom, everything just started to come down. That led over into the cash session on Thursday. And we did bounce up a little bit here, but then we were down as we're getting ready to do the overnight session into Friday. Not really seeing much in the way that we can hold on to here. The intraday growth to value ratio, I mean, they're both just getting smacked all over the place. There's really not one leading the other at this time. And we were seeing an improvement on the intraday growth to value ratio for the S&P, but now it's falling back. That's why I stopped this green area. And you're probably going to see more annotations that I'm going to put on the charts because I also have a newsletter and I'm starting to put the annotations on the charts and then that comes out in the newsletter. If you're interested in that, there's a link right below the video, and it's free for the time being. Eventually, it's going to be really inexpensive for the newsletters that I have. It'll be $8 a month, and you'll get like 9 newsletters a week. There'll be 5 daily ones and then 4 weekly ones that'll be coming out. But I'm still working through the rough draft phase of all of that. But we came down with the down day here. We need to see more follow through. Now this uptrend has not really been broken yet. It could still go back and show some more improvement, but we do need to see more follow through with our growth to value ratio. We need growth to do better than value for the market to be more positive. So growth was down more than value with the large caps, down less with the mid caps, and also down less. But look at these, -3, -2, minus, just getting hammered. We're seeing huge percentage moves these days. We actually improved a little bit with the excuse me, with the small cap growth to value ratio, but we've spent a lot of time under this 200-day moving average. We need to see more of a bounce up here for this to turn better. And we're still below the 50-day moving average with the mid cap growth to value, but we're above the 200-day moving average. But we're still well below the 200-day moving average with S&P growth to value. And you can see here, improving, but still below the moving averages. We're getting ready to see a death cross here with this ratio. And that would not be a good thing. That just shows that growth is underperforming value. Little bit of an improvement here after Wednesday, then we gave that back on Thursday with this growth to value ratio here. And after showing a little bit of improvement with discretionary to staples, we gave that back on Thursday. And coming down with the red line, that was above 40 and was looking pretty extreme here with the ADX, but we're still above the moving average, even though the ADX is trying to flatten out here. This shows a strengthening trend that's negative because the red line is above the green line. Here's the short term where we're also seeing the red line coming down. The ADX is still above 40 here in the short term, so that's still extreme, but the short term trend is still negative based on this chart. Volume still tends to be quite high, and you can see it dropped off from what we saw on Wednesday, but it's still well above average. And sentiment, we're still seeing fear increasing with the Ulcer Index. And we're coming back up now. We're above 40 with the VIX, both on a closing basis, and you can see the wide swings that we've been getting with the VIX intraday. Even though we still closed above 40, but look at we got up into the 54 range, 55 or so intraday with the VIX. A lot of fear right now. And the VIX of the VIX is now going back up as stocks went down on Thursday. The momentum for the VIX still continues to be up. And going back up here with the equity put call ratio, on a down day, that's not surprising. But now we're coming down with the 5-day chart and the 10-day chart. I'm not sure how useful these are. Sometimes I like looking at the equity put call ratios and they can really give us some insight, but sometimes they just completely go against logic here. And I'm not sure they're really helping us all that much right now. And after really coming down with this fear gauge, we went back up in Thursday's session and we went back up with this other fear gauge. So the fear that was taken out on Wednesday, a lot of it came back on Thursday. And we got the latest reading from individual investors here, actually improving a little bit, but still well below 50. That's the 7th week now that we've been below 50 with their bear bull ratio. And a little bit of a decrease here. We really bounced up with the risk on to risk off ratio, but now it came back down on Thursday. A real surprise there. But you can see these just really jerky moves in here. And after really improving the high beta to low beta ratio, that really showed some improvement after Wednesday. We gave a lot of that back on Thursday. But this is still going down. The volatility risk premium, it's not going up with the other risk or fear gauges that we're seeing right now. All right, the advanced decline line, we're still looking more positive based on price because we're above the moving average, even though we did decline. We're negative based on volume because we're below the moving average and declining. We're still below zero with our advanced decline ratio, both in the short and intermediate term. A little bit of a move here, but not extreme anymore with our advancers decliners over the last 10 days. Still looking weak here. We had fewer lows, but this is still a really extreme negative reading. So we're still going down with the 5 and the 10-day moving averages. But we're positive here with the accumulation distribution. We're still above this moving average. And so that's a smart money indicator that's still positive, and we're positive with the Chaikin money flow. The histogram showed some improvement and the red line's going up, and we're also now positive again with the Chaikin oscillator. So all of our other indicators are negative, but our smart money indicators are now positive. And we're negative here with the vortex. The red line is above the green line, and we're negative here with the advanced decline line studies. We're just continuing to break further down below the moving averages. And we've been under here for a while, so now we're starting to see the moving, not so much for the S&P, that's flat, but we're starting to see the moving average go down with these other indexes, the NYC common stock, the mid caps, and the small caps. Getting a really extreme negative reading here with the broad market measure of the 5 period moving average of the highs and lows. We're well below this red line, which sometimes marks a bottom. And we're also extreme negative with those stocks above their 20 period moving averages in the S&P. 11% are now above their short-term moving average. We're still extreme negative with the 50 period moving average study, the 100 period moving average study. We came out of that only to go back in after Thursday. Same thing with the 200 period moving average study. We just have 26.8% of stocks in the S&P above their 200-day moving average. So, kind of looking at this, we shot back up and we filled this gap when we were coming down here. Is that all the market wanted to do, was fill this gap and then start to go back down? We don't know the answer to that. We can just look at this and say, okay, that might be what's happening right now. But what's more concerning is you see how the 50 period moving average is inching its way down to the 200-day moving average. We have the 50-day moving average at 57.75, and the 200-day moving average is at 57.54. So getting very close here. And this would turn the short-term trend to negative. And then we were extreme positive with the advanced decline line on a percentage basis. That's after Wednesday. Now we went back down to extreme negative after Thursday. So a schizophrenic market right now. We're extreme negative with the 20-50 period moving average study. We declined, but we're not extreme with the 200 period moving average study. And we went extreme positive with the big update on Wednesday with the Stochk RSI. Well, that's not lasting very long. And we're below the midpoint with the Williams percent R. These are showing that there's really no conviction in the market right now. The CCI 14, not really showing anything. It's not extreme negative, nor is the CCI 20. And even the stochastics. Usually this is always on the list with one of these three charts here. We're just about at the midpoint in the short term. We're still going up in the intermediate term and the long term, but we're not extreme right now. And we went way extreme with the force index. Then we had the big up day and we went extreme positive. Well, now we're back down here. I mean, my goodness. I hope you don't get motion sickness. And the rate of change going back 10 periods, we are now back to being extreme after we worked that off. The short-term trend's still looking weak here. These lines are just not quite sure what to do. And we're still, though, believe it or not, we're only in the -1 channel with the standard deviations chart. We went down so far so fast, these standard deviation lines are having a hard time keeping up. And then this is trueflation. This is what they're coming up with the inflation rate actually being, it's still at 1.34%. Intermediate term, just falling a little bit below the midpoint with the balance of power. With all the choppiness going on, this indicator is having a difficult time figuring out, okay, which is in the lead right now, the buyers or the sellers. And we're still with the lighter shade of purple with the no-go system. And we're still coming and dealing with the lowest low values here below the midpoint. This is where the TTM squeeze was showing some improvement. It changed to the lighter shade of red. Well, with Thursday's decline, it's back to the deeper shade of red and falling further below the line. And just to give it some more perspective, this is a longer term chart of the TTM squeeze. The condition of the intermediate term trend still is weakening. And we try to get back some of these anchored moving averages as far as support levels. Well, gave that back up. We were able to get right a little bit above it here on Wednesday. Now we're back below it. That's what I talk about when the market's just blowing through these support and resistance levels really easily right now. And we're below all the moving averages here. We're watching the 50 coming down and possibly crossing below the 200 unless things really improve and then stay improved. And we're far away from the 20 and 50 period moving averages, but we've had much deeper readings negative than what we've seen, and that didn't seem to help all that much. And now we are 14.26% below the closing high set back in February. We're still in correction territory, but we haven't gone in on a closing basis. We haven't gone above this 20% level. That would switch things over to a bear market. And then the rate of change 50 periods, it was just trying to not be extreme negative. Well, it went back down to being extreme negative after Thursday and still showing some improvement, but quite negative with the ease of movement. And just because we've been jockeying around so much here, the standard deviation, this measures speed, not movement or not direction here. It's actually coming down a little bit, but we're getting very high readings now. We're extreme negative with the Arun indicator, meaning sellers are in control versus buyers. And we're not extreme, even though we declined with the S&P McClellan oscillator, but we continue to be below zero. When we're below zero, the summation index based on price declines, and then we're still declining here based on volume. We're also below zero with the NYSE McClellan oscillator. So when that's negative, we're going down with the summation index based on price as well as volume. And the swell trading oscillator continues to decline. If we get down here, we're getting to an extreme negative reading, but we're not there yet. And momentum is already extreme. The PMO, it's really coming down here, and we're declining based on price and volume. We worked off this extreme negative reading with the PMOs that are rising, but then they went and declined on Thursday. The buy signals are improving a little bit, but still extreme negative, and we're still declining and could be getting close to extreme with the PMOs that are above zero. And then we've gone from positive back to neutral with the Elder's Impulse system for the S&P. We're negative with the parabolic SAR. We're extreme negative here with the short-term slope oscillator. Extreme negative, even though we bounced a little with the MACD. So all of our, now this is interesting though. In the short term, the slope oscillator, which I just showed the bigger chart of, that's declining. But see what the TSI, this is our other short-term oscillator. They're not really lining up with each other. They're giving conflicting signals. Then intermediate term showing a little bit of a bounce here, but still negative, and we're still declining with our longer term oscillators. And the copy curve is really going down. And to give you a longer term perspective, we're getting to an extreme negative area again. And we're extreme negative with the Sean trend meter. We're below the moving average with unbalanced volume. We're below 50 with the money flow as well as the ultimate oscillator. RSI is back down. It was improving. The intermediate term is below 50. And the short term is also just barely got back up to 50. Now it came back down. And we actually saw a little bit of an improvement with the bullish percent index. I don't know if I'd really call this positive, but it is trying to cross above its moving average. And we're extreme negative here with the NYSE bullish percent index, even though it ticked up just a little bit there. And after really being extreme, we're bouncing back up here with the NASDAQ 100 bullish percent index, but we're still below this red line. So we're still extreme negative, even though it's improving. And then we're possibly seeing another mass index signal in the process of being triggered. We really haven't worked off that first signal that happened. And this is three criteria. We go above the red dash line, the blue line, then the signal is triggered when we come back down below the red dash line. Well, we haven't really seen anything happen with that. So now it's back above the blue line again. And if it comes back down to the red dash line, then that would generate another signal. We're not sure if that would be an up signal or a down signal at that point. We have to see what is the context that leads this to come back down to the red dash line. Oh, and just because if you've been watching these videos after this, I've been showing a praying bottom fisher signal. That's gone now. That's not on the books anymore. All right, and then this was looking better. This is a Fibonacci retracement chart going from the April 2024 lows to the February 2025 highs. We were able to get back above this 38.2% retracement level. Well, now we're back down below it. These are the other support. The market really pays attention to these things, and they're just blowing through it like it does, like going through a stop sign at 3 o'clock in the morning. It's like nobody else is going to be driving, so we're just going to go ahead and plow right through. And then here's a longer term chart going back to the low set in October 2022. Now, this is actually positive for the time being. We held at this 50% level and we were able to get back above the 38.2% level, and we're still above that for right now. This is longer term. So it's holding up at least better for right now. And then this is the pivot points where we broke below this S1 level. We were able to get that back. And even with the decline, we're still above this S1 level. So that's another longer term support level that's still holding. And we're still above the midpoint, even with Thursday's decline. That big update on Wednesday got us back out of the trend channel, the midpoint anyway, and it's still holding for right now. So long-term support is still holding. Short and intermediate term support, it's just not being pretty much ignored right now. And then here's a long-term trend line going from the October 2022 low to the October 2023 low. We have bounced off of that. Even though we're giving back those gains, this support level is still holding for right now. And we're looking a little more positive here with the Heiken Ashi chart, but we're negative with the Kegi chart. We're red and pointing down, and we're negative with the Renko chart, but we're positive with the three-line break chart. I mean, you got these different trending chart patterns that we use here, and they're giving mixed signals right now. These charts are very confused, just like the market is. And with the down day, well, on Wednesday, we saw a lot of X's being drawn in. And then with the down day, now we're seeing more red O's drawn in here. There was a signal, a pole reversal signal, which should be positive. Well, that's now gone because we're seeing more zeros in here that's making this chart look more negative. And we're still extreme negative again with the 150. I guess I should have put the 200 back on the list. That's gone down to being extreme here. And we're negative in the short and intermediate term with all our stock indexes, and but negative across the board with the mid caps and small caps. Bonds are now turning more negative in the short term and long term, but the intermediate term's holding up. Commodities are seeing more weakness here, so that's not really feeding into inflation, but the dollar is now negative across the board. And then all of the sectors ended up being negative except for defensive staples, toilet paper and toothpaste. That ended up being up slightly, but you can see energy's just been getting hammered there. And then tech, discretionary communication. These are the three big growth areas, and they saw more weakness to the downside. Some green, some red. It's looking more Christmassy here, but as we were going up or down, we saw an awful lot of alerts being triggered. Gold is been holding up about the best. It got above 3,100 here. And the people that have been saying for 15, 20 years now, buy gold, buy gold, buy gold, they're looking like geniuses now, even though for 14 of those years they were wrong. Anyway, here's the Dow. We're below the 200-day moving average. We're watching this 50-day moving average coming down. That's a concern. And we've gone from positive to neutral with the Elder's Impulse system for the diamonds. This is the NASDAQ. It's now crossing over negative. We call that a death cross. It's a golden cross when we're going to the upside. It's a death cross when we're crossing down below it. And we've gone from positive to neutral with the NASDAQ. We're getting close here with the NASDAQ 100. These are the biggest stocks that make up the NASDAQ, and that's getting ever so close to a death cross there. We've gone from positive to neutral with the Elder's Impulse system. The momentum is trying to improve for the NASDAQ 100, but still negative. And we've already seen a death cross here with the small caps, the S&P 600, as well as the Russell 2000. And those stocks are clearly negative right now, but they still remain neutral with the Elder's Impulse system. We also have seen a recent death cross with the mid caps and still neutral as far as the Elder's Impulse system. Still well below the 200-day moving average here with the Wilshire, a broad market measure. We're also watching this blue line coming down to this red line. And we're also seeing that same thing with the total U.S. stock ETF. Well below the 200-day moving average. This could be getting ready to signal over into a death cross. The financial sector, which really looked better, it was able to reclaim its 200-day moving average on Wednesday. Well, it's now back down below it. And the FANG index, a little further away with the 50 and 200-day moving averages, but the longer we stay down here, the more this blue line is going to come down. And Apple, which is in a downtrend, it was down 4.25%. Amazon below its 200-day moving average, down over 5%. Microsoft came back up to its 50-day moving average, but it's already in a downtrend. It was down just a mere 2.34%. And Meta, trying to regain its 200-day moving average, still in a more solid uptrend here, but the longer we stay down here, the more that's going to be damaged. And Google starting to generate a death cross. It was down 3.71%. Nvidia, which is also in a downtrend, it was down almost 6%. Tesla, which can't seem to get above its 200-day moving average, it was down 7.27%. And Netflix, again, one of the stronger looking areas, it was down 2.57%, below its 50-day moving average, but still above its 200. And still seeing more of a strong correlation in the short term between the U.S. and world stocks, with the longer term correlation also getting stronger. Oil continues to go down. We're getting into the low 60s now, and this is the dollar. And I have a line here right at 100. We'll have to see. This is another one of those tricks that other countries might play, is to really try to show the dollar getting weaker. But that could actually help the market. The stock market likes a weaker dollar. But the value of a currency is also how much confidence is there in that particular country. And if we see the currency going down, that could also be interpreted as a loss of confidence. And then we're watching this too. This is the SPY to Staples ratio. This is how it unfolded at the end of 2021, and then we went down after that. Are we seeing that same thing here? We don't really have a clear answer to that, other than things are weak right now. But usually this tops out and starts to come down before we see a top in the market. Because you can see here, we actually hit a top with this ratio back in January, and then the S&P hit an all-time high in the middle of February. And so this is a little scary, and we just want to keep an eye on this. This could show further deterioration in the market. All right, here's bonds. Then they actually kind of behaved on Thursday here. And even though there's a pretty wide bar here, we ended up closing down, and we were up just a little bit with the actually, this has us down based on price. Okay. And seeing a little bit of an improvement here with the growth to value ratios for the Qs to S&P. We're getting above the moving average, but the moving average is still going down. Discretionary has been actually holding up a little bit better, and we're showing some improvement when we compare large cap growth to value. So the large caps are improving. We're actually above the moving average with the mid caps, and the small caps are improving a little bit there. Is that going to even matter? All right, and we're still extreme negative. We're not extreme negative with the S&P right now, with those stocks that are above their 50-period moving average, but we're still extreme negative. We're just barely below this red line with the mid caps and the small caps. And we use this like an oscillator to mean that we're oversold, which sometimes can produce a bounce. All right, so what's the outlook? Really no changes here. We're still negative in the short and intermediate term and mixed in the long term. We're going to get PPI. That's the other big report of the month. And then consumer sentiment. Now, this is what caused a lot of freakouts a couple of months ago. This report came in weak, and that was used as justification. And we have really been having some difficulties ever since then. So we're going to be watching this report. And then all the different things going on right now. Are we going to go into a recession? Are we not? Well, how are relations between China and the U.S. as far as the tariffs? And then we've got the war between Russia and Ukraine and things going on in Israel. There's still lots happening in Israel, but it's not pop news. It's not headline news right now, but there's still a lot of things happening there. And here, this finishes out the economic calendar for the week. Also, with this other economic calendar. Seasonality, not much of an edge either way. Slightly positive with the Dow and S&P, slightly negative with the Nasdaq. Okay, then this is where we're just not really following seasonality right now. So it's like, okay, we'll just have to see how things play out. And we're certainly not following what has historically been solid for April, no matter how you look at it. So we are still negative with the S&P and NYSE McClellan oscillators and summation indexes. The parabolic SAR is negative. The momentum is negative. And the bullish percent indexes are negative. The Swindler trading oscillator, the moving average studies, the ease of movement, the money flow, the ultimate oscillator, the vortex, all negative. And our long-term special K chart continues to be negative, as well as the momentum for the NASDAQ 100. We're still looking positive with our smart money indicators. So that's kind of confusing the consensus here a little bit. And we're still hanging on to uptrends in the long term when we look at growth to value and discretionary to staples. But as I pointed out in that chart, we could be seeing that change here pretty soon. Financial sector is still positive, but we're still below the 200-day moving average with the bank ETF. And the mass index reverse signal, it's still on the books, but the praying bottom fisher has now fallen off. Okay, so our conclusion, we're still negative in the short and intermediate term, mixed in the long term. There was no follow through to Wednesday's pretty monstrous day there. In the short term, we're oversold and we're negative, but now we're back to declining, and that's what we're seeing in the intermediate term, where we're still positive in the long term because of the golden cross back in 2023, but we're below the 200-day simple moving average. That's why I say we are mixed. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.